Subadra, Rajappa, head of U.S. rate strategy at Societe Generale. Stephen, I'll start with you. I'm not dunking on the Fed, okay? They're much smarter than I am. I could never do their job. It's hard. A lot of variables.
Great observation you just made.
Yeah, I'm just pointing out that what they said was going to be happening right now, 1 year ago, couldn't have been more off.
But that's exactly it. Again, what we will be thinking about the economy at this time next year is going to be very different. Where we were a year ago, exactly right. Where the Fed was in 2019, expecting to go further, expecting QT to continue. You know, all of these things. We just have to realize that if you go in 75 basis point increments, you're delivering, as they will today, the equivalent of a full year of monetary tightening in the space of 4 months. If you simply over-medicate the patient and don't wait for the notion of how long it takes for this dose to get through to the economy, you know, you are at risk of creating more damage than you intend. And it's in next year's economy, next year's inflation rate that we'll see that. We could definitely give you some points and show exactly what is happening on a forward-looking basis that is not obvious today.
Subadra, I'm going to trust you, I think, more than the Federal Reserve on rates. Where do you see interest rates 1 year from now?
That's, of course, a very hard question to answer, given how, as you pointed out, just a year ago, two-year yields were around 20 basis points last year this time. So we're looking at just a precipitous rise in yields. But I think I agree with the premise that Steve was laying out earlier, which is that I think that the Fed is definitely keen on front-loading rate hikes, getting rates to perhaps 4% by the end of the year, maybe peak Fed funds rate at 4.5%. But broadly speaking, I think that, as we all know, policy works with long and variable lags. So they're eager to get rates out to 4% and beyond, but they're going to really need to see the impact, broadly speaking, of higher policy rates. And you're already starting to see that somewhat in employment is strong, but then you're starting to hear of headlines of people laying off workers. You're also seeing that on other metrics, on the earnings. I'm sorry, on the forward guidance from the FedExes of the world. So there's still there's definitely some slowing down in some of the metrics, but again, it's too early. The economy is still pretty strong. The trajectory for rates is probably higher over the near term.
Hey, would you agree with that, Stephen? Probably higher?
I think it is. It's the way they've operated. Again, probably moving up rapidly will mean that we will not sustain as higher rates as we would get if they were going gradually, if they were allowing the economy to adjust to it. Whether that's good news or bad news for you, that's to consider. But I just give a concrete example for everyone. We have had the monthly pace of new home sales from the end of 2020 to now. It's fallen 51%. What are construction outlays? What are housing completions? -2%. Why? Because it takes 6 to 12 months to plan and build a house. The construction pace is based on where interest rates were, what the sales pace was when it was higher and rates lower. Construction employment is at an all-time high trying to complete these houses. We're going to see very large, probably double-digit drops in construction-related employment in the coming year. And it's pretty obvious, and this is going to spread more broadly to the economy. It's just the easier example of interest rate sensitivity. So in the coming year, when employment falls, the Fed will react to it then. And they have even back in the days of Paul Volcker.